Hello, Market Rebels. Well, a question we get a lot is regarding stop orders and stop limit orders. What are they? What's the difference? How do you use them and why? Well, stop orders and stop limit orders are very similar. You can think of them as cousins, but there are some differences that you need to be aware of. But basically, whichever one you choose is that these are orders that allow you to buy or sell if a specific stock price is reached. That's probably the simplest way to describe what these orders do. Now, they are usually used defensively to exit positions if you are heading into losses, or maybe just trying to protect profits. But they can also be used offensively to enter trades. Now, for this video, we're just going to talk about the defensive use, but understand that you can also use them as ways to get into trades. Stops and stop limits can be used on a lot of different assets, definitely for stock, options, ETFs, but they cannot be used on mutual funds. And that's just because of the way that mutual funds trade. So just keep that in mind. So when it comes to entering trades in the market, there are two basic ways to specify a price. You can use a market order or you can use a limit order. And we have to understand these because that's really what stop and stop limits come down to. We're going to find out that one converts to a market order and the other converts to a limit order. So we've got to understand the differences here. So let's start with a market order. If you place a market order, then the order is guaranteed to fill. That's the good news. The bad news is that they do not guarantee the price. You can't be 100% certain as to which price you're going to pay if you're buying or which price you're going to receive if you're selling. Now, if the markets are open, it should be pretty close to the prices that you're seeing on the screen, but just realize that they could be a little bit higher or a little bit lower. Now, on the other hand, a limit order will guarantee the price. That's the good news, but they do not guarantee the fill. So it's always a trade-off. You get to guarantee one or the other. So limit orders may only get filled for your limit price or a more favorable price. Sometimes traders think that your limit orders can only get filled for exactly that limit, and that's not true. They can also get filled at a more favorable price. So for instance, let's say that these are all of the possible stock prices, and you place an order to buy 100 shares at a limit of 100. And so what that means is that you're just telling the broker you are willing to buy 100 shares if you can get the order filled for 100 or less. Lower prices are more favorable. The exchanges are assuming that if you're willing to pay 100, you should be very happy to pay something less than that. So it could be filled for 100 or anything less. On the other hand, let's say that you place an order to sell 100 shares at a limit of 100. When you name your limit for a sell order, it's saying I'm willing to sell these shares if I can get this limit price or higher. So in this example, you could only get filled if it was for $100 or more. All right, so once you understand the differences between market and limit orders, you're now ready to tackle stop and stop limits. So what is a stop order? Well, stop orders are, again, usually used to close an existing position. They can be done to protect gains. So maybe you bought stock at 100, it's trading for 120, and you'd like to put a stop just in case it starts going against you, trying to lock in some of those gains. But you can also use a stop order to minimize losses. So you bought the stock at 100, and if it falls to 95, you'd like to get out. So for a long stock position, what are the risks? Well, remember your risk graph. It's a straight line for long shares of stock. You can make dollar for dollar up, and you can lose dollar for dollar if it falls. So notice that right here is your zero line. So there is your risk right there to the downside. So how would a stop order work on a long stock position? Well, because the risk is to the downside, we're going to be putting our stops below the current stock price. So let's say that you buy 100 shares of ABC for $100. Now you could have just purchased these, or maybe they've been in your account for a week or possibly even years. But you've got the shares in your account. But now you're thinking, just in case they fall below my purchase price too far, I'd like to automate a trade so I can sell these shares, let's say if they fall to 95. What you would do is you would place a separate order. This would be a second order to sell 100 shares at a stop of 95. And let's just say that it's good till canceled. Good till canceled means that the order remains active or open until you cancel it or until it's filled. So notice that your stop price right here, the important thing about the stop price is that it is the trigger price. Too many times traders think that the stop price is the price you're guaranteed to get, and that is absolutely not true. It's just a line in the sand. And what we're saying is that if ABC trades at or below 95, or whatever stop price you put in there, the order is activated. Or in the business, it's actually called elected. But that just means the order becomes activated, it's live. What happens now? It becomes a market order. That's the key to understand about a regular stop order. It converts to a market order. And that means it is absolutely guaranteed to sell, but it also means that you're not guaranteed to get 95. Why? Well, because you could get the stock price to gap, could gap way down. So let's take a look at a couple of examples, one where a stop order works well and another where it doesn't work so well. So let's say that this is our stock chart and you buy shares up here for 100. And so obviously you're bullish, you think the price is going higher, but you're also thinking, well, what if it falls? I'd like to maybe have a little insurance policy here and get out if the stock price falls to 95 or less. So you place a separate order to sell your shares at a stop of 95. And what that's telling the broker is that if the stock trades at 95 or below, to sell your shares. So here's a case where it could work really well. Stock is moving along nicely. As long as it stays above your stop price, it's never going to trigger. But now let's say it does start to move and it starts to slowly fall until it hits your stop price of 95. The rule says if it trades at 95 or below, activate the order. So that's what's happened here. But because it got activated right at 95, you're probably going to get filled very close to 95. This is a case where a stop order can work exactly like you thought. But where can it backfire? Well, let's back up and let's say that the stock starts slowly moving down, moving against us. But one night it closes just above our stop, maybe at 95.10, really any price above there, but it hasn't triggered our order, but the stock price is pretty close. But the next day, there's bad news. Maybe the company announces earnings and the stock gaps way down, let's say, to 80. Well, remember what the rule is. If it trades at or below 95, activate the order, which it's done, but where's the current market? Yeah, it's down here at 80. So now you're going to get filled closer to 80 instead of the $95 price that you thought. So this is where a stop order can backfire. All right, so that's the basics for a stop order for long shares of stock. What about short shares of stock? Well, this is our risk graph for short shares. Again, here's our zero line. And notice that you can make dollar for dollar if the stock price falls, but you lose dollar for dollar if it rises. So a short stock position is bearish. You're actually going to make money if the stock price falls. But notice where the risk is. It's up here. If the stock price rises, that's where you start heading into losses. So for short stock positions, you would place a stop order above the current stock price. So let's go have a look. Let's say that you short 100 shares of ABC at $100, obviously thinking the price is going to go down. But just as a little insurance policy, you buy 100 shares at a stop of, let's say, 105, and again, we'll make it good till canceled. The key point to understand in all cases, whether it's a stop or a stop limit, that the stop price is your trigger price. That's really a good word to use while you're learning this. And what that means is that if ABC trades at or above 105, the order is activated and it now becomes a market order and you are guaranteed to buy. But as always, you're not guaranteed to pay your stop price of 105. So where could it work well and where could it work not so well? Well, let's go back to our stock chart and say that you short shares here at 100. And for a little insurance policy, you place a separate order to buy shares at a stop of 105. So the stop price is the trigger point. It's the line in the sand. And if the stock price moves lower, all is good. You're going to make money. You're never going to get triggered out of this position. But if the stock price starts to rise and starts moving against you, this is where we might trigger the order. So here it has just touched 105. And the rule says if it trades at or above, activate the order. So in this case, because it's right at 105, yeah, it's probably going to work exactly like you planned. You're going to pay very close to 105 and exit this short stock position. But where can it backfire? With a gap. Let's say that instead the stock price starts moving higher, but it stops a little short of your stop price. Maybe it's trading at 104.90 or some other price below 105. The next day there's really positive news. The stock gaps up to 120. What happens now? Well, the rule says if it trades at or above 105, activate the order and become a live market order. So now in this example, you will be buying shares at 120 instead of the 105 that you thought. So probably the key thing to remember is that with a stop order, it is not guaranteed to fill at your stop price. That's just the activation point, and that will keep you out of a lot of trouble if you just remember that point. But what if you don't like the idea of the uncertainty of prices? Well, this is where stop limit orders come in, but they also have their own limitations. So what is a stop limit order? Well, for stop limit orders, you are going to specify two prices. One is the stop price. It serves exactly the same function that it does for a regular stop order. But the second is your limit price. And yes, that's exactly right. It means that the stop limit order, if it's triggered, is going to submit a limit order, not a market order. So for example, let's say that you buy 100 shares of ABC at $100, and just in case it falls, you place an order to sell 100 shares at a stop price of 95, good till canceled, but you also put a stop limit of 94 on it. Notice that you've named two prices. Here is your stop order, and here is your stop limit. Now, in most cases, traders will place their stop limit order to be something less than their stop order. In this example, we've listed 94 instead of 95. You don't have to. You could make them the same. You could even make your stop limit greater. I could have made it 96. As you'll find out, that doesn't usually make a lot of sense, but the point is you could do it. But most traders will put their stop limit a little below to allow for some slippage, and that'll make more sense in a little bit. So what this order is saying is that if ABC trades at or below 95, that's the stop price, the order is activated, and it now becomes a limit order to sell for any price greater than your limit price of 94. So for instance, let's go back to our stock chart and say that you bought shares of stock for 100, but just in case the price falls, you place a sell stop limit. And you place a second order to sell shares at a stop of 95 with a stop limit of 94. Well, your stop price is 95. That's your trigger point. And as long as the stock price stays above it, no problems. You'll never trigger the order. But if it falls down and let's say just touches 95, yes, it's going to activate the order. The computer is going to submit a live limit order to say, sell my shares at 94 or higher. Well, because the stock is trading right now at 95, yes, you're probably going to get filled right now immediately for 95. In this case, it worked beautifully. Where can it backfire? Well, again, if the stock is falling, but let's say it closes just above 95, again, maybe at 95.10. The next day there's bad news, it gaps way down to 80. What does the rule say? The rule says if it trades at or below 95, which it did, activate the order, but now become a live limit order. So now with the stock down at 80, you've got a live limit order to sell at 94. And that means you're still holding on to the shares. You haven't sold them because the The computer is trying to get 94 or more. Stock's down at 80. So this is where it can backfire. You're trying to get out of your position, and what happens if you get these big gaps, you might end up holding the shares. All right, let's take a look at how a stop limit order could help you for short shares. So if you short 100 shares of ABC at 100, you might say, just in case the price rises, let me place an order to buy 100 shares at a stop of, let's say, 105 good till canceled, but with a stop limit of 107. As before, you have named two prices. One here is your stop price at 105. The other is your stop limit price, in this case at 107. So if ABC trades at or above 105, the order is activated, but now it becomes a limit order. And in this example, it's a live order to buy at 107 or less. Remember, for the buy side, limit orders are for that price or less. So now if this trigger is activated, it will only fill if the broker can get 107 or less. So the main thing to see is that neither of these prevent losses. And that's a myth that a lot of traders have. They say, oh, place your stops and you can really manage your risk. Possibly, but not necessarily. So here's how both of these can fail. Let's say that you have long shares at 100 and you place a stop at 95. And the stock, however, gaps down to 90. So let's compare the two. Let's compare a stop order to a stop limit. If you placed just a stop order at 95, what happens? Well, remember, the stock is down at 90. You have definitely sold. And so you have a realized $10 loss. You paid 100, you just sold for 90, you've definitely got a $10 loss locked in. Well, what if you did the stop limit order? Well, now, let's say you place the order to sell at a stop of 95 with a stop limit of 94. If the stock gaps down to 90, you now have a live limit order. You have not sold your shares because you're trying to get 94, but the stock's at 90. So in this instance, we would say that you have an unrealized $10 loss. It's not a realized loss because you haven't sold the shares yet. Instead, you're still holding on to them. So notice in both cases, it is a loss. So again, the key takeaway is that stop orders do not prevent losses. Now, years ago, they used to be called stop loss orders. That's where they get their names from. But that was until the SEC got a number of complaints from investors saying, hey, my broker told me to put a stop loss on, implying that I'm going to stop losses at a certain level. And they just didn't. So they said now, technically, professional traders should not be using the term stop loss, but instead just call them stop orders, or more simply, stops. So which should you use? Well, there's a pretty simple rule to follow. If there's a price at which you'd rather hold the shares, use a stop limit. On the other hand, if you're saying, I don't care, I just want out of the stock, no matter what the price, then go ahead and use a stop order. But be careful what you wish for. If you bought those shares at 100 and you place a stop at 95 and you get 70, are you really going to be okay with that? If so, by all means, use the stop order. But think carefully about it. If there is a price at which you'd rather hold, probably a good idea to use a stop limit order and get exactly what you wanted. So the main thing to realize is that when you're talking about stop orders or stop limit orders, always understand that a stop order converts to a market order. That's the big key. If you're using stop limit orders, they will convert to limit orders. And if you keep these points in mind, it will go a long way in helping you to figure out which one to use and when, and that can only make you a more successful trader.